All right. What is up, everybody? Happy weekend. Maxi King is in the house already. This is good. How's it going, my friend? Wait for a couple people to come in here. How's it going, man? Might not have too many people. Some people trickling in. Trickling in. Mhm. Oh, is it later on YouTube? I think I may have announced maybe the wrong time. That's okay if they trickle in. Got about 5 people. Yeah, that's right. Cause like, I wish there were a way I could kinda, like, coordinate the announcements better between, like, X and YouTube. Cause I know there's a sizable, like, portion of people who participate on YouTube who, like, don't have X accounts, so when I, like or and they're yeah, how is that? Or, like, I guess sometimes when people on X who, like, view the videos, sometimes they'll, like, miss some of the announcements there. I don't know. But we're trickling in. We're trickling in. We'll get started in a second. Bring up some stuff here. Mm, give everybody a few minutes. How'd the week go, Maxie? There we go. People are popping in now. Up to 9. um, yeah, yeah. Um, usually you have to wait till she's awake to enjoy the TNA, but that's some good fun for our 98% male audience. Yeah, fun analytics. Um, YouTube audience is 98% male. Yeah, man. Why don't we take a look at that now? Actually, that's a good idea. I don't usually take a look at XRT options. Let's pop over there. Actually, let's take a look at Thinkorswim first here. Take a look, see what we got. Here's our XRT chart. All right. So pretty similar to GameStop, pretty basic equities options. Let's get over to the volume and OI. Let's see. Oh, not a lot. Why? This is weird. There's like a lot of calls. So number one, there's not a lot of activity on this options chain really at all. This looks like for weeklies today, like 0 DTEs, we maybe had like maybe 200 or 300 contracts traded, not even like opened, traded. So very low. OI, there's like 2,000 contracts at 82.50, and that's like it for this week. And everything is out of the money. This week, 7 calls. 7 calls were out of the money, or in the money, I should say. And over on the put side, big OI position at 77.5. So I guess that makes sense, right? What's our range here? Yeah, basically, let's mark this up a bit. It's kind of weird. You got sort of a. Can we get this working? Kind of like here, right? And then we've got this kind of consolidation spot here. And then, yeah, actually, right? Similar action on XRT compared to GameStop, right? We got this doom candle here once again. No, come on. What are you doing to me? Yeah, when did this pop up? Day after, actually, the XRT doom candle was the day after our big dump, I think, in GameStop. I want to say we got prior to January OPEX, our doom candle was on Tuesday. Yeah, it was a Tuesday doom candle right here. Yeah, so that's interesting. It came the day after. Let's look a little farther out in terms of XRT options. We can see what we have. Okay, next week, there's nothing. Yeah, like there are last week was interesting that there were a couple strikes where we at least had several thousand sold, but like for next week right now, I don't even know that there are 500 contracts of open interest total on both sides of the chain, like together. So that's interesting. Um, that's different for February OPEX. We have many, many thousands of contracts for February OPEX. 3,000 at 82, 2,000 at 81 and a half, 3,000 at 80, 3,000 in the money down at 75 on the call side. And on the put side, mostly puts here, huh? 1,000 at 71, 4,500 75, 2,500 76, 4,500 77, 2,500 78, 3,500 79. So that's, that's more of what an active options chain would look like. Let's maybe head over to unusual whales and just see what like some of that might look like there. Yeah. Yeah, I don't look at it really hardly ever. I mean, I'll look at the price a bit, right? I'll be like, okay, like what's going on here? Can we see what's happening? Like what's volume like? What's the price like? Um but yeah, like it's the sort of thing that I don't it's the sort of thing I don't necessarily look at in terms of like, oh, can I trade this in terms of options, something like that. Yes. Yeah, 7 calls in the money, man. There were 7. Bro, I always bring the BDE. Thong Song, is that by Palestrina? I think that's Giovanni Pierluigi da Palestrina, right? He was the official composer for the Sistine Chapel. I think he's the one who came up with that, right? All right. Let's pop over to unusual whales for a bit here. XRT. Let's share. All right. Do 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 do. All right, here you are. Do we even have XRT here? There it is. Yeah. So, yeah, that was today's volume. Oh no, this was OPEX. So like, where did we even have volume? Not much, man. This is a weak options chain. This is not. This is illiquid. I imagine the spreads on this are terrible. Yeah, what are the bid ask spreads on this? At the money is 78. So what? Like for the 21st of Feb. Oh, this is terrible. I would hate trading this. You like can't. This is like so this is basically of a situation where like you don't even have quotes. Like the spread between like the closest spread I'm seeing here is it like 71, kind of decently out of the money for OPEX. Anything else, even the at the money stuff has the spread is terrible. So it's a small. All right. So just kind of like my summary kind of ideas on that is like, um, yeah, definitely that's not something I'm gonna trade. Just because like I don't even know who's doing that, or yeah, it's very illiquid. There's not a lot of, yeah, XRT, right? That's going to be like so little of that is going to be driven by options volume. So little of the price action is going to be driven by options volume since there isn't any. Um, yeah, we could see if there's some big transactions here. I need to go over here. Oh wow, it's like all puts. Wow, look at this. This is all by time. I've never seen so many puts traded in a row. Look at this. It's just all puts. Puts, 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 puts. Not huge orders, but maybe there's a better bid-ask spread there. It's a mix of short and long puts, but it's puts. This is a combo. This is a big order. Puts, 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 puts. Stuff way out too, like June OPEX stuff. Here's some February OPEX stuff. We can sort by premium, see if there are any big orders. Very bearish total premiums. I mean, not very much in the way of premium in general, but we did have, I would say, this is a pretty decent size order. Wow, that's pretty big. Somebody bought almost 7,000. Are these the same order here? These may be the same order. These are the same order. This is the same order. Sorry, somebody bought over 8,000 or just about 8,000 puts for March. $77. This order. Let's see this come up on the tape here. That's unusual. That I would say is unusual. It's the only activity at this strike. And I guess there was another one tied in there that didn't get bundled in with it. An order of 1,000 before. Yeah, so there were somebody bought 9,000 puts for $1.5 million for March on XRT. Not sure what that means, but that is very unusual. Yeah. So hopefully that tells us something down the road. But Maxi says, I have a question in the current IV environment. Would it be worth it to sell shares to buy a deep in the money call for January 16? Well, I would say, how would I evaluate that? So you'd have to say, okay, what are the advantages and disadvantages of doing that? So first thing I would say is it's going to depend on your options permissions. So um, you let's say you're looking at a deep in the money call, right? Which you are, right, for January 16th next year. If you look at something like 20s versus actually owning the shares at this point, you can control 100 shares for not quite a third of the cost of actually holding the shares. Probably like 2/5 of the cost of holding the shares. So, your money's going, whatever that is, 150% farther, something like that. If you have the right options permissions, so if you can sell multi-leg, if you can do multi-leg options trades, like if you can sell covered calls, but you can cover them with deep in the money options. So brokers will let you do that, but not everybody has the requisite permissions. You can essentially treat the deep in the money calls like they are shares. So like you have 100 shares that you can sell covered calls on, if you have a deep in the money call like that, you can effectively treat that as collateral for your covered calls. You're just doing it under leverage. So um, the disadvantage there obviously is like, you will take a bigger percentage hit if you see the price continue to go down. And depending on how much time it takes for GameStop to kind of recover, you could you have a time component that you could kind of lose out on. But because IV right now is so low, and that's something I'll point out to us, right? So even this week, we have dipped even further down into into like 52-week IV lows. Get a quick refresh here. Yep. And we are pretty darn close to not exactly where we were back in late October, but we're pretty close. And we're below where we were now, except for one day. We are below where we were in August. If we bump back to April, I think we're below where we were in April too. We are. Yeah. So only one day in August and one or 2 days in October do we actually have any kind of values on our 52-week, 52-week lows. So to finish up with Maxi's question here, so it's a question of leverage, right? So if you don't have as much cash, or you want your cash to go farther, and you're willing to take on the risks of, um, you know, dealing with the fact that you have a little bit more risk in the underlying, you don't have an infinite amount of time, so you take on a little bit of that risk, but what you get back from that is you get a significant amount more leverage, which means you need essentially then less collateral in order to cover, in order to cover, say, like your covered call positions. So you can sell more calls on less money. So as long as you know that you can use that component, right, then that can kind of make up for, um, that kind of extra risk you're taking on. And if we get this big kind of up move in March, even if we get this kind of IV appreciative effect that we've seen happen for about 2-week periods going into earnings, then you know those calls will probably pick up some value. So even if we kind of hang out price wise where we are now, like they will appreciate in value, not as much as a shorter term thing, but you know. So you have to like go into some options calculators, kind of like look at your position, take a look at the risks. Also think about, like, it can be hard to see this far out at this point, but I would say use an options calculator and like take a look at how early on time loss is going to affect that position and such. So Yeah, they're not on every broker, so. Yeah, we got some regulars coming in. Cosmo, what's up, man? Great to see you. Yeah. What's up, Guido? Yeah, so yeah, a lot of, I would say, especially those big days where we just kind of dump for no reason on not appropriate. Like, yeah, this is a topic I touched on this week with respect to the Wyckoff theory stuff. I think I talked about this in yesterday's video. Um, but basically, a couple weeks ago too, we can take some time to look at that. So let me see. If we head over to, I think a really good comparison is actually the what happened in August. Mm, where's our? What happened to Thinkorswim? Why can't I show Thinkorswim? This is weird. Okay, we'll just do entire screen, I guess. Hopefully y'all can see that. That's kind of weird, but okay. Um, so let's go to, yeah, GME. So yeah, Guido brings up a good point here, right? Like, what's really driving the downward price action here, and like, how can we tell that this is? It's likely that a lot of this has to do with heavy shorting rather than anything going on that's like organic. Um, so the first thing I'll say is a part of this might have to do with XRT. We can go look at Richard's sheet, which I'll point out to you guys if you haven't had a chance. Right, Richard makes like his entire whole spreadsheet setup is completely um, open access, so you can go take a look at it. To know specifically, I guess, if it's XRT, we'd have to see what would it be? I guess what outflows would look like, something like that. And I guess there's been a lot of has there been a lot of redemption? I guess it's been redemption orders. So they put in the creation orders. With a creation order, XRT goes out and buys the stock, right? So whoever's actually managing XRT or whatever other fund is going to go out and buy the stock, hold the stock, and then is going to issue a share to the authorized participant. So let's say it's Citadel because that's GameStop's equities market maker. Um, Citadel's going to go, okay, creation order, XRT. We want more shares of XRT to exist. So I think there's something like, right, the money goes over to, whoever is running XRT, whoever's I guess the market maker, the manager for XRT. Um, XRT goes out, buys this basket of shares that make up, right, it creates a share, and then they hand that share over to Citadel, let's say in this case. Then what Citadel can do is Citadel can issue a redemption order where then they convert that share into actual equities from XRT. So XRT will then hand over the actual shares that share is said to represent. So then XRT itself is holding a share of itself, whereas, excuse me, the authorized participant is then holding the basket of stocks that map to a share of the ETF, which then, for example, then Citadel or something can go and then sell those or short those or whatever. They can also, I think, disproportionately redeem a different allocation of that basket of stocks independent of what the actual weighting is in the ETF, right? So they could like redeem a share of XRT for like all GameStop shares and not any of the other things in there, something like that. I'd actually, this is stuff I've heard more or less reported to me. This kind of, oh, it can just be all, um, it can all be GameStop shares. I'm not sure to the extent to which that's actually how that works. I haven't like looked at any of the actual documentation on it. This is just kind of hearsay from other people in the internet space. But so like it can be XRT, it can be other funds. To know, I guess, which funds are being tapped the most, or I guess to get a sense of what they would be, um, right, Richard on his sheet tracks ETF outflows. So ETF outflows, if you see ETF outflows happen, that is generally an indication that redemption orders are being put in. So shares of the underlying security of the underlying ETF, or what the ETF shares map to, are being transferred to authorized participants. And I guess that's what's replenishing the lend pool, something like that. Um, yeah, Richard understands this process and can detail this process a bit better than I can at this point. Still figuring out some of the actual, like, okay, like who's actually going in here, like what actually happens when this exchange takes place. But that's more or less how I understand that process. In any case, um, we have been seeing GameStop shares, GameStop shares available to borrow have been ticking up. I'll say, especially this week into today, they really ticked up back to 2.5 million. So okay, how can we tell, like when we're looking at the chart, like what does this kind of synthetic short position, like synthetic liquidity and shorting, look like versus like authentic selling, right? So let's say I was very cynical of this idea that there's this kind of suppressive conspiracy against GameStop by certain institutions, right? Because the theory is there are certain institutions that create all this synthetic liquidity and then use this synthetic liquidity to control the price so that they can roll swaps or they can keep the price down, whatnot, to make it less, interesting to purchase or something like that, to keep kind of investors away from GameStop. Um, right, we've seen that, like Citadel, right? There's a recent statement by Ken Griffin, maybe like 4 or 5 months ago, who basically says that this is what they do, right? We adjust the prices. We use like our position as market maker to adjust the prices of equities to where we believe they should be, is like a direct quote from Ken Griffin. So how do you do that? You do that by creating synthetic liquidity. You do that by you use the mechanics of it. You don't like go punch in some code and you're like, there's not some intern sitting at a desk and like Griffin calls them up and is just like, make the price $24 now, right? This is how they do that, or this is at least the clearest description of how they would go about doing that while still basically operating within the mechanics of the market, I should say. So let's still say I was a cynical person. I'd say, well, how do you know this isn't just a sell-off? How do you know that like it got overpriced, right? This classic, oh, it's overpriced versus the fundamentals, and now it's selling off. I mean, to a certain extent, that may be true, but just because something is overpriced with reference to the fundamentals, or there's potential growth, right? How many growth stocks have 5 to 10 years of growth priced in? Like how much of Apple's growth is priced in? How much of Nvidia has been priced in for the next 5 to 10 years? And nobody says like, oh yes, it's selling off because it's just overvalued versus its earnings or growth or something like that, right? That's not the excuse for why this stuff happens until it's convenient for whoever wants to adjust the price downward to explain why that's happening. It's generally what it's not like you can't like operate basically on that to explain why why in the short term a stock is moving down. So okay, Guido asked this question: how can we tell the difference necessarily between like this kind of authentic sell-off bit and what is adjusting the price downward via shorting, via this kind of synthetic liquidity shorting. And if we take a look at August, I pointed this out in some of my videos more recently. Let's see, let's get in here. We want the 4-hour chart. No, we want our daily chart. So if we take a look at, yeah, our price action in here, right? So with general buying patterns, right? Wyckoff theory has been able to track this, right? People have been working with this for, a century now. And basically, right, what happens with kind of these phases of, right, you have kind of four main phases: accumulation, markup, distribution, markdown, and then it kind of repeats. And you have corrections in there, retracements, consolidation, like within this. And you have three kind of movement paradigms. You have consolidation, consolidatory movements, or range bound movements, which, like, I'll mark these in like light blue. Like, for example, right, light blue, range bound, green, bullish regression channel, right? This is a markup movement, and or markup type, I should say. And then red stuff is markdown, right? So you'll see basically, even within these trends, you'll see kind of markup, consolidation, range bound, and then this is kind of range bound, a little bit of a markup, and then we move into a more fuller markdown spot here, consolidation, markup, right? So this is accumulation. Accumulation precedes markup, and distribution, which I guess this precedes markdown. So how do you know, or how can you anticipate, like, how do Wyckoff analysts actually figure out, how do they anticipate when a stock is going to move into a markdown? How do you know when these markup phases are going to end? How do you know when you're in the midst of a consolidation period, a distribution phase, and not just sort of a slight kind of pullback or consolidation that then moves into um, another leg of markup, right? So, for example, here we got a pullback, which again, right? If you go and look at, we talked about this back end of November, early December. This also was driven by shorting. However, because of how high volume this was, there was also a bit of selling here, right? Like up at the top. Well, not this, but you'll notice when GameStop comes down, like, the volume on its way down is usually half what it is on the way up. So that doesn't necessarily, like, it doesn't necessarily have to be 1 to 1, but as a rule of thumb, what you should see to gauge where at large the stock is moving, whether you're really going to shift into a markdown or whether you're going to continue, you're just kind of at a pullback and then consolidation and then markup yet further, you should see a change in the distribution of volume overall. So in a markup phase, you should see when the stock moves up that volume spikes. So volume up, price up, volume down, price down is what you should see. So when the price moves down, the volume moves down, and that's how you can tell, okay, there's a very strong chance, right? This is going to continue back to the upside. We're just kind of pulling back and consolidating, and then you use technicals to basically figure out, okay, where are we going to consolidate? You look for things like higher lows, lower highs. That's going to signals consolidation. And then you look for kind of a point where it gets too narrow. You look for breakout, and then you enter at that point. Okay. Trade the breakout and then continue on the up movement. Okay. If we go ahead and look at what was occurring back in August, right? here. So this was prior to the last Nikkei bottom here. So if you look at the daily volume on how this stuff moves down, it's roughly even, right? So it can be spread across more days or more concentrated in other days. It doesn't necessarily have to be exactly 1-to-1. But as you see, like as we saw this kind of movement up, right? So if we move back just a little bit, right, kind of coming off this second top here, right? So, okay, big volume up, big volume down, right? Big volume up here, doo-doo-doo, and then big volume down. Okay, so this is authentic. Like this is people selling. This is people who bought in here, the stock traded up, became overpriced by general market sentiment, and then sold off. Okay, so this was buyers going, I'm taking profits on my position. While I can, I'm getting out of this position. Okay, then we went through another phase, like a tight range bound phase here, right? Volume down, but generally kind of evened out. We found support down here at the 50-day moving average, and then volume started to pick up on some of these upward moves. Okay, this was the run up to right 29.91, I think we got up to. And if you look at the volume bars as this started to move up, so consolidating in here, and then when we crossed above the 20-day moving average, then we really traded up into July OPEX, so a few days before July OPEX. Now, I'm not going to say that there wasn't any shorting in here, but this was also, we can presume that this was also heavy profit taking based on how our volume matches up. So up here we get something, right? We get 13 million shares a day, 16 million, 17 million, 25 million. But then on the way down, 23 million, 16 million, 12 million, 14 million, right? We see it on the way down. Volume is roughly equal on both sides of this. This makes sense. And then this volume on the way down also kind of matches up here. Yes, the price slips a bit lower than here, but you know, this is authentic distribution. This is people who bought back in here during this accumulation phase. We had a little bit of a markup and then markdown. And then there were ETF outflows. A lot of this selling had to do with general market selling off and whatnot. Sure, that's where a lot of that sell volume came from. And of course, as we see, we move down and volume goes down. So this is authentic, or volume goes up. So this is authentic sell pressure. And it doesn't even out, right? And we kind of have this too, because then we recover, but it's a lower volume recovery. We go down, but then it doesn't match this impetus here. So this is a signal that, you know, we're not necessarily going to punch for a lower low. And then we get our earnings stuff in here, which is a little bit wild. But in any case, my point here is what occurred here was actually what you would expect from authentic buying action, what you would expect from organic supply and demand and evaluation with respect to the price and the future of what was coming. And then we got this range bound period, and then okay, we traded up for a while. We did not have that here. So what has occurred since we kind of moved into this, like, yes, this area here, this press towards 35 was comparatively lower volume to what we had kind of in the consolidatory phase and prior, but we've been moving down on comparatively less volume than we moved up on. So we did have this one day of 11 million, but this this one 11 million day and a 5 million day, a 7 million day, 6 million day, right? These days here, maybe about 20 million, accounted for something like 80 or 90 million volume on the way up. So when you look at that, right, you'd say, okay, there has to be some kind of event, because the price can move down when there's some other kind of event coming in that people start to get panicky about, right? If there's some crazy news, something materially changes in the company, yeah, there can be a crazy fast markdown where it's not necessarily going to just go off of supply and demand based off of what's occurring with respect to the technicals and volume and whatnot. We had nothing, right? We had no news, that nothing occurred, and yet the stock completely retraced. Well, like this entire segment, right? It retraced in a day, couple days. This entire segment, all of this organic buying volume, and then continued down. And if you look too, right, any of these days where we've punched lower, it's like volume keeps punching down. The days where we move up here, bigger than the days on this side of things. So the stock continues to move down on lower volume than it moved up on. It's covering more territory to the downside on basically nothing driving that. Yeah, there's you can't explain it by people sort of reevaluating their theses on the fundamentals of the stock based on how it's trading currently. Nor has there been any news to suggest that people are changing, people would change on this, right, unexpectedly. So then, on top of that, taking a look at what we've seen in terms of like shares available to borrow data, things like that. That's what it looks like. So that's kind of the big question mark that comes up in GameStop regarding these movements, and it's why I think it's something that really continues to draw fascination and scratch heads and things to that effect. So I'd actually, if you have a chance, I would go check out some of Eric from Outlier Trading. Guy with a lot of experience. He's got, I think, 17 years trading experience. He's also, since I think last summer, he's also started to talk about GameStop and go through GameStop stuff. Another great guy to get perspective on, like, from the wow, he's a really experienced trader, so he's coming at this from looks at some slightly different data versus what I do or what Richard does. But yeah, interesting to personally for me to kind of look at my technical analysis and look at try to understand what's going on, right, as I'm a newer person to this. Just a few years under my belt trying to understand what's going on, then to look at, hear this from Eric's perspective, who's seen 17 years of this, and just go, GameStop is nothing like anything I have seen TA wise in all of my years of trading. And he directly comes out and says that. He's like, TA, classical analysis of this stuff, it's not useless, but it selectively follows TA, and then it just doesn't. So something is going on here. It's very obvious to him. And I think he's been drawn to this too, to kind of take a look at, hey, all right, let me try to understand some of these dynamics. He's been pretty systematically, I think on the weekends, he has a Saturday live stream where he'll just kind of go through the library of DD, kind of one classic Reddit post at a time, and try and figure out what's going on. So he also has that kind of perspective where he's like, this is nothing like anything I've ever seen. So very interesting. Cosmo, great question here on cash secured puts as an income stream. Sure, like what strikes and such would be instructive with the understanding no encouragement. Of course, yeah. So so sure, let's hop over to Thinkorswim again. So basically, like I've told you what my kind of principal strategy is when I'm targeting short options in general. Um, I will target. I personally will target very high probability out of the money strikes. So if we look at, let's take a look at um, February OPEX, right? I'll use gamma data, gamma exposure, market maker gamma exposure to try to figure out where we have kind of our principal trading bracket. And I'll use technical analysis to try to figure out, okay, how does options data here line up with our technical data? How do these two coincide with one another to let me know what is the highest probable range for the next few weeks or something like that? So on covered call trades, and I use covered call trades first because I use them more because GameStop is trading is more skewed towards covered calls. They're a lot more liquid. The premiums are a lot better priced. You can get better premiums out of covered calls versus cash secured puts. Um, so let's take 30. The $30 covered call trade is probably the easiest one that I've done. Do a lot of like I said, I tend to be more conservative with it. I tend not to want to target stuff too far below that kind of overhead call wall. So when we were trading around 20s, when we were in like 20, 21, 22, I basically didn't trade covered calls below 25. Didn't do this because we had that call wall at 25. I was like, okay, I pretty much know there's like a market maker conspiracy that the price is not allowed to go above this for a while. Like until they're really ready to go above this, it's not going above this. But call wall is a good target like for that, right? So even on SPY, right, 90% of the time, where there's a lot less market maker control on SPY because it's so huge and there's so much money sloshing around, it's harder to control SPY. Like, how do you control the whole S&P? Even that, like normal movements on the S&P, I think Spot Gamma has backtested that on 88% of trading days, the stock will trade below the call wall. So you can at least count on that for GameStop. And what we've seen is anytime the call wall is about to be breached, or if it gets breached, like it'll go past 25, we'll get excited, or it'll go past 30, we get excited. But then it's like another 2-3 weeks before it actually closes above the call wall. So using the call wall as a target for covered calls, if you're in an uptrend, if you're range bound, right, they're going to be better in an uptrend or range bound. Obviously, if you're trading down, that's a little bit more difficult. Or sorry, it's a little easier for it to expire out of the money. But because you're in lower IV conditions, your strike price targeting needs to be a little different. So when we were in an uptrend, what I was targeting was I continued to target the call wall, but because we were moving up and we were moving up fast, I way condensed what my expiries were, because I was like, okay, any day now, right? Because we're getting activity from the company, we're getting attention from Roaring Kitty, we're getting enthusiastic buying, we're moving up. Okay, this week I could sell some 35s, but there's or 30s in the early part of this. But there's no guarantee that in, say, a week or 2 weeks, we actually close below 30. We could really punch above this and stay above this. And I want to ride this as long as possible. I don't really want my shares to get assigned. So I'm going to really walk this in terms of I'm going to sell it for this week, or I'm going to sell it for next week, or something like that. So when we're in higher IV conditions, I don't really change the strike too much in terms of what I'm targeting. I still target the call wall, but I walk the expiry in a lot. So rather than do, say, a month or a month and a half, which was like I was doing like up to kind of 45 days out in this area, because I was like, I don't think we're going to move until like here. So when we were back here, I was trading here. I was trading September monthlies, and then in here, or was it September? No, this was here. I was trading October monthlies, and then in here, I was trading November OPEX monthlies. And when we got to basically in here, I stopped trading those. Right, I stopped doing November monthlies. We moved up in here, and then I started trading $30 like $30 calls short, like 2 weeks out. And then here I started doing 35s 2 weeks out, went back to doing 30s. This was back to doing 30s 2 weeks out. Before earnings, I did 30s 1 week out. And so I'd kind of, rotate parts of this in and out, right? So that's kind of right. And then as we moved into here, then it was like, okay, IV's on the way down. So basically, once we had this big move, I unfortunately, right, I didn't know this was going to. I thought if this was going to happen, I thought it would happen a few days later. I was basically saying my strategy was, okay, I'm going to wait till Wednesday. You remember I talked about this in my videos. I was like, okay, I think Wednesday, if we're going to get something from Cohen or Kitty or something like that, it's going to come on Wednesday, because that's kind of the ideal positioning with respect to OPEX. So if we're going to see something, it's going to be then. If we're not, then something's not going to happen before OPEX, basically. And coming out of OPEX, we're going to lose that foundation. Well, I guess whoever, the magicians that pull the strings kind of figured that out. And so they tanked everything on Tuesday to cover their asses, I guess. And so that happened early. So I didn't get to capture any of this movement, unfortunately. But then, was it in here? Somewhere in here. Basically, when I saw, oh, okay, we're moving down, we started to consolidate. And on this kind of move back up here, I sold February 30s, right? So now it's like, okay, now we're in lower IV conditions. Do it, a month out. Month out. All right. So for cash secured puts, Cosmo, I trade those less often, largely because I like to trade based on liquidity of covered calls. Like I said, I like to trade those more often. And so more of my cash tends to be in a GameStop position, either through I have some deep in the money calls that I use to kind of leverage my cash a little bit better to sell covered calls. But for a cash secured put, I also traded a lot of CSPs in here, which were great. They were so great on the up movement, right? Because premiums were really high, and then we just didn't trade down. So that was very excellent. And so you want to, for those, I would target what would be kind of like an inverse call wall position. So what would form up as a call wall kind of below us in the event that we kind of start to fall down or fall back within a particular trading range. So obviously, here, when I was trading cash secured puts, typically with CSPs on GameStop, you have to trade them a little bit farther out. Here it was easier, right? Again, you could walk in the expiries because IV was very high. Lower IV, you got to walk them out. So here I was trading in August, yeah, back all the way back in August, I traded September CSPs. 20s? Yeah, I think I was doing 20s mostly. So looking at that kind of bottom bracket and then going, okay, in August, sure, I'll sell 20s, right? We're down here basically around 22. I'll sell 20s. The break-even price is like 19 something. Will I take 100 shares of GameStop at 1950? Sure will. I don't even think I got, yeah, even when we went down, I don't think I got assigned on that. No, I don't think, no, I didn't. No. So looking at these brackets and then targeting like the high likelihood kind of ranges of the bracket itself, and then going, okay, would I be happy with being assigned more shares of GameStop at whatever the strike price is minus the premium? And do I always hold those to expiry? No, I don't always hold those to expiry. A very common strategy if you're doing monthly, so if you're in lower IV, is to go from 45 to like 30 days. Sometimes you can push it out to 20 days. You'll see most of the value. If you're trading range bound, you'll see, like if it's a range bound situation like this, you'll lose most of the value in those by like day from 45 to 30. You'll probably lose more than 50% of the value between day 45 and day 30. You'll lose like 70 to 75% by 20 days to expiry. And then you can sort of roll it out to, then you can exit that and then enter into another one that's, for a later expiry, go back into a 45 strike. Here again, you can do, because it's more volatile, you can walk in the expiry. I traded lots of 30s in here. So I'd do like 2 weeks out, 30s, and then just those I would hold to expiry, or I would exit like on Friday or something like that when they were worth like 2 cents. So those worked out really well. In the downtrend, it's actually kind of getting like, if we do hold this technical support, because this is the thing, this probably threw some cash secured put traders for kind of a loop here, because this was difficult. Like, we really looked like we were moving back into a range bound formation, and then we got this surprise on Monday. Yeah, we have held the 200-day moving average here. So yeah, so if I were going to trade covered calls on the, or covered cash secured puts, I'd probably do something like, let's take a look. Maybe March, like I said, not trade advice, not financial advice. If I were to do this, that's not bad. What does this take us down to? 22. Sell these for 230. 22. 22 something would be the price you get assigned. That's not bad. Right, target these for March. Sell them somewhere in here. IV's low, so if we go back up to the upside, they'll pick up a little bit of IV, but you then have price working for you, so those will end up being profitable. And then target, I would say for now, right, I would probably target an exit, because we're up here. Target an exit for them, basically like in a month. So something like around the time of 7th of March expiry, maybe a little bit after that. If they're not like in the money or deeper in the money at that point, which it could happen, right? We could get a late February kind of leg down into the 22 area, in which case they would be in the money and probably just about the same price as they are now, in which case I'd continue to hold them into the earnings period. If not, if we then kind of end up around 25 and just kind of stay around 25 and trade in this area, they'll lose about 70% of their value by this point, in which case I would exit them, because then we'd get this 2-week IB appreciation effect, and I would want to be, I guess, in shares or long calls or something like that, so then I could sell covered calls at the top of that. Yeah. So it's like there's always a relationship between, okay, how am I managing these two positions? Like, how am I managing the covered call side of things? How am I measuring the cash secured put side of things? How much do I want what is underlying this, or what I have as collateral, to be in shares or deep in the money calls or cash? And what relationship, what do I think is going to happen in terms of price and IV especially IV in the short term. Does that make sense? Does that answer your question, Cosmo? Hopefully, that was informative to everybody there. Mojoception. I don't see Cosmo, but hopefully he got that. Okay, let's go back to the comments. Where were we here? Oh, so many. There we go. Okay. Roy's going off the grid. I have not seen these videos here. Oh, come here. There we go. Snuffy here one, not yet. I'm going to keep this in a separate tab. Yeah, that was very interesting. Actually, what I saw right going into today was we did have quite a lot of call sales actually heading into this weekend. If we didn't get that massive pullback in SPY, this is what's really interesting to me. I don't mean to be a conspiracy theorist, and I'm not trying to be like, oh, the whole market is rigged to kill GameStop. I think for a portion of time that was true. I'm not sure to what extent that's true now. But what is very interesting to me is that every time we're about to have this moment of like, okay, GameStop looks like it's going to have a reverse, the whole market tanks and then kills the possibility of that. So if we head back over to today, right, that's what happened today. I'll go into depth on this when I put up my my breakdown for Monday, my article for Monday. But yeah, like we really had a chance here basically off this kind of midline area, right? We kind of popped back up above this several times, got up to 25. Obviously, you can see how that position functioning as a, I guess, a near term call wall, kind of like a call wall, but a high positive gamma accumulation position, which tells us that yes, 25 was net long calls based on this behavior here. But why didn't somebody come in and drop some money? Like somebody could have just dropped a couple mil and it would have, we would have just run right up here. Why didn't that happen? And then we get this. And once again, we get tariffs being blamed. Just crazy volatility here, all the way down to our gamma flip line. We just realized all of that throughout the day. Well, this is weird. And the excuse here is tariffs. Not even specific tariffs, but just we'll announce tariffs. There'll be more tariffs maybe next week or something. Oh, okay, sell off. So this has happened a couple weeks now, right? Several weeks this has been the case. All of a sudden we get a market retrace, right? We pumped up super hard early, and then somehow, oh no, tariffs. So, like I said, I don't know the extent to which that's genuine, or that's something that's just like that's planned ahead of time, and then they just find a news clip to justify that. I more or less think it's the latter. I don't necessarily think like this isn't new information. Like they've known Trump is going to do this, and it's not a concrete plan. Like he's been talking about this for months and months and months and months. Going back to before he was elected. He said he was going to do this. Now he just says periodically, he just says what he's been saying, and now they're going to do a news report on it, and somehow that makes SPY tank $10. I don't know. Maybe. What do I know? I'm just a guy, right? I'm just a guy. Yeah, dog. I talk to Richard all the time. I talk to Richard all the time. He's super cool, man of God, really nice, like genuinely has a mission like I do to just understand what's going on. Doesn't come from an expert background, and he's just like, you know what? Just gonna focus on this, talk about this. You know, you can ask. He's really helpful with yeah, just what he looks at, right? What I value so much is like ideally, right? So coming from an academic background, like ideally how academia should work, right? You guys like you look at a certain problem, you're trying to understand how something's working, some kind of natural phenomenon, and then you naturally come into contact, right, with people who are looking at the same thing. And then but you have differently configured brains, right? You have slight differences in the way that you can approach stuff or look at stuff, or you have different ideas that tell you like, I'm going to go look at this or I'm going to go look at that. And so what's really great is Richard and I very frequently, I've said this on my channel too or in videos, like we very frequently will see similar things and we'll come to conclusions by looking at different things, similar conclusions by looking at different things. And so like sometimes I'll message him and I'll be like, hey man, like have you what about this? Like, have you been thinking about this? Like, I've been looking at this. What do you think is going on here? And he'd be like, oh, well, I was looking at this and I sort of saw this over here. And then I'll go look at that. And then, you know, he'll say something like, okay, what about this? Like, do you see this? Like I talked about this in the video. So it's super helpful. He's really great. I wanted to make sure I took a second to recommend this too. If you have not had a chance, and I'm sure, you know, this is a pretty involved like crossover core group here. I would really recommend if you have not had a chance. The title of this is Roaring Kitty Tweet Theory 7.0. But Richard has been looking. He has a sequence here where basically one sort of aspect where he's been looking into Roaring Kitty's tweets has been with respect to how they might map over to I think it's the price momentum oscillator. So I will take a look at some of this on my own. Just with respect to his video, I think it's definitely an interesting theory that maybe the tweets line up with key like key crossover moments in the price momentum oscillator, which is very interesting to consider. So it's over on Roaring Kitty's chart, right? So it's this way on the bottom here, and that basically Roaring Kitty's tweets kind of line up with key crossover moments. And that, right, so look, 29th of October was a triple, like it was when these two bottom lines, right, crossed over. What is this? The 55 day, I think, the 55-day moving average, I think. So it's something like when that crossover occurs here, that's a sign that like, whoa, big reversal. And then he had other tweets that kind of came in when these two lines here. I'm not exactly sure. I have to look in. I have to figure out actually how the two parts of the PMO actually work here. But that potentially he tweeted on kind of crossovers in here, and that yeah, his Seymour Butts, Seymour Asses, Futurama tweet in here maybe had to do with this kind of double 1-2 crossover, right? Because his tweet came in on the 21st, right? So right in here. Interesting theory. Interesting theory. I have to do some evaluation of that myself, but really excellent video. I think in bringing that technical indicator to our attention there. So I'd really recommend you go check out that video of Richard's. Yes, we can see your chat. Yeah, too. And what I always like about it, Diswag, is that a lot of times it's spontaneous. Like we will talk to each other, but like it's not like we like coordinate content or anything like that. Like we will talk to each other, but each of us is kind of pursuing curiosity and trying to understand stuff independently. And like I'll go over and look at his video, or he'll look at one of my videos, and then he'll be like, "Oh yeah, hey, I like." We'll find out that we just talked about the same topic by looking at our own stuff on the on the same day. Like what it's like besties accidentally wearing the same clothes to like fifth grade casual Friday. It's quite the thing. Oh, that's weird, man. Have you been unable to comment Snuffy's channels to us? That's weird. I will like no, I can see your text here in it in the chat here. So I'll no, I'll go check out those videos. Yeah, it does sometimes overwhelm. If you sell a call, are those shares available to be borrowed? It depends on your broker's. It depends on your I guess relationship with your broker. I don't know what the terms are with the broker. I've never explicitly agreed to allowing my shares to be borrowed, and I collect no. Nobody pays me interest on anything like that. Like I know there are brokers that come and they ask. And doesn't Fidelity ask you or something? But I have Schwab, so they've never asked me permissions to borrow the shares. But I don't know. Maybe they just. I imagine you'd have to consent to that, but maybe not. Isn't selling calls the same as buying puts? Aren't you essentially shorting the stock while holding the bag? No, not exactly. So, for buying a put, like okay, um, a covered call is, in the grand scheme of things, in the sentiment, like overall sentiment, it is technically a bearish trade, but it is bearish only on a very specific component. And it is bearish on unlimited potential upside in a limited period of time. Okay, that's very important. So I see this a lot over on I saw this a lot over on Superstonk, where people are super hostile to people who sell covered calls because they're like, oh, it's a bearish trade, and they don't like think about it beyond that. But really, what you're saying, like the trade is specifically this: you're saying, I don't think there's a reason why this. There's a reason why over on Superstonk they say it this way. Why they don't like it. What you are saying is, I will trade infinite potential upside. I will trade the possibility of benefiting. I will trade the possibility of profiting from the stock price going to infinity in the next 3 weeks for a defined profit now, right? I'll sell you the right to infinity gains in the next 3 weeks, let's say, for $150 or $100. Okay. I particularly select strike prices that mean that I'll definitely profit and that are always above the price that we are presently. So technically, when I sell covered calls, I'm still bullish. Like that's still bullish with respect to that range, but it's only bearish in the sense of above that range, right? And infinity stuff. Like I'm bearish on infinity in the next 3 weeks. That's where the bearishness is. Now, if you say, okay, well, hey, why are so many super stonk people super hostile to that? Because like a lot of people on super stonk are just like, nothing is worth sacrificing infinity gains at any moment in time. And it's like, okay, like you can go ahead and live life that way, right? But if you are always living your life unwilling to sacrifice like some kind of infinity gain, like in every single decision you're going to make, then you're not going to end up with much, right? Everything you're going to have is just going to be potential. Because we're not infinite, especially in corporate, like anything that's material, right? Anything that, let's say this, anything that is of this world is finite. And we are finite creatures in our current forms. We are not beings in our material forms that can harness infinite potential. You want to talk about incorporeal forms, you want to talk about after we no longer have bodies, like once our bodies die, like do we go into a form that can harness infinite potential? Well, maybe, right? But then you're getting into religious claims and metaphysical claims and thinking about what that would mean. How many humans have yet encompassed or experienced the fullness of infinity? No one. It's infinities, right? So, but you see how it gets kind of wishy-washy. In any case, when it comes to trading, right? What made me a profitable trader and consistently profitable was being able to say, I will take the bounded gain now on the understanding that I can make another trade again tomorrow or in a week. I will sacrifice the potential for infinity in this tiny moment with the understanding that the odds that the price goes to infinity tomorrow are astronomically low. So you collect the premium, you do that enough, you can then use that premium to then reinvest in the stock, which I do, which is then bullish. Those calls too, when I sell them, right, you have to look at what the delta necessarily is on the call. So the covered call is also going to have a way lower delta than the shares. So the net delta on that contract at any point in time, because it's smaller, means that the whole trade, right, the 100 shares and the covered call is going to be net bullish. Let's say the delta is 0.2. So, okay, when I sell that covered call, the market maker is going to go, okay, now I'm holding this. I'm holding this long call, so I'm going to sell 20 shares. Okay, and then it goes to expiry. Then the market maker, over the course of time, will buy back those 20 shares, neutralize, right? It will neutralize that bearishness over that period of time. It will expire. I will pocket the premium. I still have my 100 shares. And now we're back to 100 shares of bullishness. Right? So that's different than a put, where if I just go out and buy a long put, I am just pure bearish on the delta of that put. So the market maker will go ahead and hold that. The market maker will sell shares to hedge that short put on their books. And then I guess buy them back and then take my money, if that expires out of the money. And the only way I profit is if GameStop's price goes down. It has to go down for me to profit. So that's a very different kind of bearishness, right? So in any case, I hope that clarifies that. It's possible. Yeah, yeah. I mean, I think that to a certain degree. But the question is, right, what is the mechanism of the pricing in? Because that that's you have to say, okay, do we have an efficient market? Is the market instantaneously and consistently efficient at any point in time? If the market were perfectly efficient at any given point in time, trading would not work. You could not make money off of trading if you had a perfectly efficient market. So there is some gap. There is some degree of inefficiency that is built into the market. Okay, that's why trading can work. Um, if you assume, right, if you want to say, well, maybe it's very small and it doesn't matter, then you basically, it wouldn't be maybe worth your while to try to trade or to try to, you couldn't make money like Buffett or something like that. You couldn't swing trade things. You couldn't enter and exit things. It wouldn't really work out that well. You'd be getting a fraction of a percentage. It wouldn't be that that's what you should pursue to make all of the money. So what seems to be the case and why trading is so lucrative is there's sufficient lag in some of this discovery. And what someone like, Soros in the Forex market discovered, or what he talked about, how he was able to make a ton of money, is the market discounts reflexivity. Efficient market hypotheses discount reflexivity, which is that if people kind of adamantly refuse to accept the fact that what they have is overvalued because because it doesn't work to an abstract reference point, right? Like, the reason why what Ken Griffin's statement about, we adjust the prices of securities to where we believe they should be, that's not how it works, right? Like, the value of something is dictated by the market participants, right? It's like, you don't how do you actually assess that? There's no top-down authority that comes in. It's like why price controls like wreck an economy. Because if you set prices that don't align with the authentic valuation of the people who actually buy and hold and trade and consume goods, then you end up with shortages, you end up with problems, you end up with black holes in dysfunction in the supply and demand principles. So, I mean, the question there is, are there really just, is it that the community at large that invests in and trades GameStop really is they're going, yeah, really now I think, this went up to 30 or this went up to 35, but really I think based on what things are right now, and there's no real potential of growth after this quarter. So yeah, time to exit my position because I don't really want to hold GameStop anymore. Is that because that's the decision, right? That sort of what when you propose kind of is this just that kind of price discovery now, based on standard valuation and kind of rational assessment of the fundamentals? That's the decision that individuals have to make in a great enough proportion in order for the price to move down by the natural and authentic principles of supply and demand. So while I think, yeah, that is true, while I think, yeah, that if you do look at just the fundamentals right now and you're not thinking of what's coming in the future and you don't have kind of the cult following dynamics that GameStop has, and you assume $100 million profits, yeah, that's actually kind of a fair valuation for a retail stock. Yeah. But do I think actually that GameStop investors by and large are making their investment decisions on what is fair fundamental valuation for a retail stock with those types of profits? No, I don't. And so I think that this is conscious adjustment according to, the logic of, we just adjust the prices of stocks to where we believe they should be because they can, right? Because somebody like Citadel can, because their market maker can. So that's what I think there. But that's a great question and an important point to bring up. So I think that's an important element to why, knowing that that is the case, I think $22 as far as something we could see in the next few weeks prior to whatever happens with March earnings um, is reasonable. But of course, it begs the question, right? If that was the fair valuation, if that was a fair valuation back in October, why did it go to $35? you know. So, but great thoughts, great question, great contribution. Love that. Thank you for that. That's excellent. Cheers, Guido. Oh yeah, thanks again. Happy birthday to my mom. Yeah, just turned 71. Happy birthday, mom, again. If you watch this today, it's Saturday. Yeah, she's does her little like house cleaning thing on Saturday sometimes. I imagine maybe she puts this on in the background while she's doing that. Yeah. So happy birthday again, mom. Am I someone to explore the financials of GME and earnings? Yeah, as we get a little bit closer to earnings, I'll take a look. I'll take a look. Right, I'll probably do a video. We can talk about it during one of the live streams in a few weeks, but not quite yet. I think. I don't even know what that means, dude. Do I use covered calls in my love life? How'd I do that? I don't even know. I don't know even know how I structured that trade. Also good. I'm glad this was clear. Thanks, y'all. You guys are brilliant. Yeah, you guys ask such great questions. I'm so appreciative all the time. Everything that you guys ask, like this, is always helpful to me. Always helpful to me. Because this also gives me insight. And like, oh, hey, maybe that's something I should develop more. Oh, hey, maybe I should think about that a little more. That's really great. Love questions here. A lot of you guys send me questions too and stuff on Twitter. So like, you guys are an active part of this. Like, so much of how I've been able to develop and refine what I'm thinking and sort of consider, okay, how am I expressing this, or how am I conceiving of this? So much of that is credit to you guys for the questions and comments that you leave. So really appreciate what you guys have to contribute. Yeah, yeah, you can. Yeah, definitely you can do that. I mean, I think that's what most people end up doing. Um, GameStop is so interesting to me because and this is something maybe we can talk about this next week. I'm kind of working on an article on it now that I think I'll have a chance to post it over the weekend. But um, GameStop is so connected to so much else that's going on right now. Like, yes, okay, the market as a whole is, but GameStop is right. There's a reason it's called idiosyncratic, and there's a reason why the stuff that happens with GameStop doesn't happen, so far as we can tell, in many other obvious places. And it is connected to some of the, I think a lot of people for a while now have come to the conclusion that our financial, economic, political systems have gotten really out of whack. And right, ordinary people, we can tolerate, like, it's not necessarily perceptible. Like, yeah, there's media stuff and we can get upset about the media, or there are scandals and we can get upset about that. And it's like, you can always find something to get upset about. It's never going to be perfect. But there's a level to which things get out of whack, get out of balance, where it starts to make you have to like restructure your life because it gets so out of whack. Like this, what I'm doing now, this stuff, like I was never, and I'll kind of put this in, and I guess what I talk about, I was never really interested in finance. I just wasn't ever interested in being rich or anything like that, right? Like a lot of what draws people to wanting to make a lot of money is rich. And like all of the goals that I had as a kid or everything was all about like curiosity, excellent, like just trying to do cool things or get better at things. Like that was always what was exciting to me. Like, hey, like what can I do? Like, how strong can I get in the gym? Or like, hey, like how many books can I read? Or like how many languages can I learn? Or something. Like, just, doing that kind of stuff. And I didn't have like, I was like, whatever, like, what am I gonna do with $10 million? What am I gonna do with $50 million? I was never interested in. I was like, as long as I can do what I want to do and be with and see the people that I want to see. Now, okay, does that mean like, oh, let me go live in a box? No, like obviously, right? But part of it was I started working on this stuff because all of a sudden, like the career I was really interested in having an academic career and teaching and things like that. That was just not on the table. Nobody was interested in giving me an academic job, despite what I thought. Really seemed to be a fine way to go into that. Um, Teaching wasn't going to cut it. Like it was going to be very difficult to be able to support a family on a teaching salary. If even then I could get a full time job, right? Nobody even wanted to give me a full time job. I had to kind of Frankenstein's monster a bunch of part time stuff doing that, and I was just like, why can people on laptops like make 10x a teacher's salary like doing this? Why does this even happen? What is going on? Like, what is going on with the whole GameStop thing? Why does this happen? This is so baffling to me, right? And like we see, I think part of the reason that so many people, myself included, have turned not only to GameStop or trading or investment, but online stuff in general, it's like, why is it necessary now to basically like earn at an exponential scale? Like why is it that you must basically understand finance to this level to even like kind of make ends meet, right? Why is that the case? And I think a lot of that has to do with how far things have gotten out of whack, how far things have been disrupted in terms of, yeah, basically how to a certain extent corruption, but maybe also, you know, trying to disguise actually how the system works in order to further certain ends, if in political careers or Wall Street or whatever have you. So I think next week we'll have a chance to talk about this, but I'll go check out like inflation data. I want to talk about this is what I'm working on from shadow statistics. So basically, like, right, the main premise is in 1980, right, the government changed how they evaluated CPI data, right? How they evaluated inflation, and developed it didn't change that much prior to 1990, but then in 1990 they put in a new, right, the Fed and the government started releasing inflation data based on a new standard. And as you can see, by 93, so by the Clinton administration, right, Bush, it started to diverge in first Bush. Clinton administration, though, into second Bush. This was true for both of their presidencies. They actually like diverged, right? So blue line here is CPI if you use the 1980 model, right? Whereas this is what's reported. The red line is what has been reported since basically 1990, right? And you can see the divergence. At least, like, the only thing that changed in this was beginning with the Obama presidency into Trump and Biden here. At least they stopped becoming more different like they're already hugely different. You can, what do you transpose this up by like 7 or 8% difference between these? Whereas from Clinton through Bush, they became more different the whole time. So the gap widened over time between these. The gap widening has stopped, but they're so hugely different. And because these are percentages, right? This is rate of inflation. Essentially, the government has been lying about inflation for 30 to 35 years, to the extent that, you know, inflation now, total inflation across that period, is now probably something like 4 or 5 times what it has been across that period. So for comparison, right, the government basically has said that only in like 3 of the past 30 years has inflation only surpassed 5%. Only like 3 times has it gone above 5%. If you use the 1980 metrics, um, it's never gone below 5% since 1990. It went above 5% in 1990 and then hasn't gone below that. In fact, 5% in 2009, where the government said that they had achieved negative inflation, is the only time it ever actually got back to 5%, which is bad, right? And this is what I want to develop, kind of talk through this and sort of think through some of the different dimensions of this, that, hopefully will give some additional insight into, yeah, why GameStop is also so interesting to me. But yeah, maybe at some point, like if the GameStop saga is resolved, maybe I'll turn my attention elsewhere. But we'll see. I take everything one day at a time. I'm just like, every day I'm doing this, I'm like, is today the day? Is today the day where I just don't know what I'm talking about? And I figure that this is, I'm wasting people's time, and I'll just I don't know, go sell rolls or something. I don't know. But every day that answer is no, keep going. So I'll keep going. Yeah. Yeah, got a little deep on you there, man. Yeah, man. Toodaloo indeed. Yeah, man, that's the idea. That's the idea. Like that's why I haven't like changed. Like this is what I set out to figure out. Like I've always been interested in these principles of Renaissance. Like you can let me know if sometime you guys like actually want to talk about the Renaissance. I actually spent 10 years doing for my undergraduate education, and 7 years in grad school, like getting my PhD and reading all of this stuff like in Latin and whatever. Like if you want to know, right, what the Renaissance was actually about, like always happy to talk about it. But basically at the end of all that, I was like, I think there's a renaissance now. Like actually, and I don't mean that as like hubris, like, oh, like Renaissance, like, painting, and like, no, like there's something way, way deeper in terms of the revitalization and reorientation and reform of society that happens in cultures and societies, at it doesn't happen all that often. So it's something that comes along every few centuries. And I really think that you know, there is a real natural phenomenon that can be described in human society, in human culture, in human life as Renaissance, and that we are in the midst of that type of phase right now. That is going on right now, and part of my interest in GameStop really is connected to all that, because I think this is. Yeah, it's something that I'm waiting, right? I'm waiting for like the people who are doing like all the government stuff, who are doing like the culture stuff, like you start to see these people kind of getting in touch, right? So like what's his face? So Ryan Cohen, right, started to like comment on like some of Jordan Peterson's stuff, and right, he's trying to do that on like a cultural kind of thing, and with education, and there's like a bunch of education people there, and like kind of religious life that he's touching on, and then like that's kind of touching on the political stuff. So like whatever, like Polyev up in Canada or something like that, and then you've got Ryan Cohen in here at GameStop, and I'm like, ooh, they're really close. Like, what I don't see is I don't see a lot of people talking finance in the cultural domain, like in the whole, whatever Peterson and Pajot or Stephen Blackwood or like that kind of group of people, or or the political people like commentators like Douglas Murray or Konstantin Kisian or whoever else is involved in this stuff, right? I don't quite see them. They kind of started to with the kind of questioning the ESG stuff with like BlackRock and whatnot, or like thinking about like what Deloitte is doing and BCG. But I'm waiting for them to like connect the dots with GameStop and be like, oh, that's like a piece that from the puzzle that's missing. So I'm waiting on that. I'm interested to see how that kind of plays out. Um, but yeah, cool to point that out, Guido. Yeah, man. That's why. I mean, it can make sense. Buy and hold can make sense here, but you're basically waiting for other people to solve the problem for you, is what it is. And that could be the right choice. If you really you're basically banking on the real fundamental transformation of the company to so override all of what is going on, that major institutions try to like fuck the people. Like it'd have to be like War of the Gods, right? Like some people would have to be like other Wall Street guys would have to be like, it's time to destroy Citadel, and then like have them counter financial warfare Citadel in order to actually do that. Like that's kind of so like the bet on Ryan Cohen is that. The bet on Ryan Cohen is Ryan Cohen will transform the company, and then that transformation of the company will make the other big dogs on Wall Street attack Citadel and just like rip Citadel to pieces. And then that will allow for true price discovery to occur. That's also an if on that. And so what like Roaring Kitty is doing too is Roaring Kitty is like actively trying to come in and say like, okay, how can I help this? How can I further this? But until that, then like you're really just twiddling your thumbs until that happens, basically. If what you're doing is just buy and hold, and that can be the right choice if you can't. And this is wisdom, right? You need to do like kind of self-reflection. Are you the kind of person, do you really have the capacity to get things like options trading right? Because it's super hard. And like even me, right, like I said, I do super conservative stuff. It works for me, but that took some discovery, and it took me several years of also kind of not getting stuff right, and trying to fix those mistakes and trying to figure that out. And then I did, and okay, and now that's how I make money and support myself. But that took a while before that was how I did that. And for some people, yeah, it probably is better. Like it probably is a better strategy for you to stick with the job and the career that you have and have that salary, and then like take money off of that and put it into buy and hold and kind of wait for somebody like Roaring Kitty and Cohen and market reform and this whole thing to play out, rather than try to figure out what's going on. So that can make sense. Yeah. Yeah, man. It was, yeah. We can go into we can go into some more academia blues sometime in the future. Yeah. Yeah. That's right. I did have I posted a bit of. Oh man, how many PhD people we got in here, dude? Oh, this is awesome. Daphne is also a PhD. What's up, man? This is cool. I'm just like I love disillusioned academic crew. This is the best. This is the best. Yeah. Yeah, like I'll start now that I know we have some. I mean, I've wanted to do this for a bit, like kind of start to work this into, I don't know, talk about some of this stuff on the weekends, kind of get away from the nitty gritty and the technicals and all that, which is great to have. Obviously that's going to take up still the lion's share of stuff, but kind of get into some of those additional connections, maybe over the weekend and stuff. Bro, they will, man. It's going to be awesome. So my orientation towards the like Foucault's doctrine of the epistemes. Yeah, so Foucault, right? So for those maybe who are not familiar with the terminology, right? Foucault has the idea of the epistemes, episteme from Greek, and paradigm shift from Thomas Kuhn. Um, Something like that. I think that's probably part of it. The thing about the epistemes and paradigm shift is they're not, and this is I can't take full credit for this um, encapsulation. I forget who else. Maybe Peterson said something like this. Maybe Ian McGilchrist too. But it's something like no, yeah, it's like I think both of them as they comment on Jean Piaget or something like that. I think it's Piaget who actually says it. But like Foucault's notion of the episteme and Thomas Kuhn's notion of the paradigm shift uh, basically say like, right, you have like there are ways that we view the world and come to understand the world and come to have knowledge about the world. And over time, right, we have a functional model of how that works. And as long as that model continues to be functional, adequately functional, we don't actually push beyond that model, right? Um, we don't push ourselves to invest more energy in right. We don't, as Thomas Sowell would say, we don't push ourselves to up our knowledge costs if there is not adequate return. Right, we economize our knowledge because we're finite beings, and we only have like it takes energy. Right, knowledge isn't free. You don't automatically get knowledge. Right, the idea of studying is you are trading life hours, energy, attention, creative potential. You trade all of this in order to acquire knowledge. The acquisition of knowledge is an active, energy intensive operation. And so, if you don't need to acquire new knowledge, if you're basically like if you're living and you're progressing and you are making sufficient progress in whatever you're pursuing in order to live a good life, you have food and self safety, shelter, family life, right? You're getting all your needs met, including your need for sort of the entertainment of your curiosity. Then you don't really need to pursue or explore new avenues of knowledge, something like that. But when you encounter difficulty, right? When enough, or let's say this, in the episteme and in the paradigm shift element, eventually anomalies, right? You run into anomalies that challenge the validity of your paradigm or of the episteme, and so you sort of graduate into there's an accretion of these anomalies, and you have to that sort of force you to reconfigure how you see the world, force you to rearticulate your model. And with Foucault and with Kuhn, they kind of just change, right? It's like you replace one model with another. And Foucault is, I guess, more concerned with the kinds of knowledge that rearticulate the model, whereas Kuhn is more interested in the model itself. But there's sort of there's one model, and then you replace it with another one. There's one way of conceiving of knowledge, and then you replace it with another one. And then there's another, and then you just sort of, you shift from these different sort of slices or these different models, but you kind of collapse it and throw it out, and collapse it and throw it out. And so, especially with Foucault, right, because he's, sort of transformations, he's postmodern sort of transformations of Marxism, which is based on sort of revolutionary ideas. The idea that it's revolution, it's revolution that brings about the next thing, right? Just like calling it in Kuhn's idea, right? A scientific revolution. Okay, there's a scientific revolution, right? Kuhn's book is The Structure of Scientific Revolutions. And there's an idea of something, there's an idea of revolution as something that is deconstructive, and that's specifically a postmodern idea. Kuhn is sort of less, it's not just a postmodern idea. It's also a Marxist idea. It's also a Jacobin idea prior to Marxism, right? That's sort of Jacobins being the pioneers of this in the French Revolution. So the idea there is like, revolution, deconstructing the whole system, throwing it out, and then building something else up from scratch is how you move forward. But there is, I suppose, what sort of Piaget kind of has there, and what kind of Peterson develops a bit, and McGilchrist to a certain extent, is like, you actually have, you don't, like, as human beings, we don't throw out everything, right? We hierarchate models, and we embed, right? There's an order of magnitude or an order of validity of the epistemes or of these different models. And when we reach a certain layer of it that becomes dysfunctional because of all the different anomalies or dangers or threats or something that we encounter, we only do it one layer at a time. And then we reconstruct the layer. And then once we've done that, we kind of re-hierarchate everything. It's a reorganization, but we don't throw everything out. Something like that. We can develop that more at a later point in time, but that's sort of my, that makes more sense to me. But it would probably take another hour for me to lay out the whole case as to why I think that's the case. But yeah, great question. Yeah. So maybe that's a good note to maybe that's a good note for us to end on. The epistemes and the structure of scientific revolutions. So, but yeah, it's something like that, right? I think there's more to it than just that. But yeah, that's a good time for us, I think, to wrap up the stream. So yeah, thanks very much, guys. This was a great time, as always. Like I said, keep the questions coming. It's great talking to you guys. It's great having you on board. We'll see. Like I said, I'll be still traveling over the next couple weeks or so. So we might change, some different times. I know a lot of the Euro folks, because this is now super late on, Central European time or British time, who love to join us, didn't have a chance to join today. So we might put the stream on Saturday next week. I'll think about what's gonna work best. Maybe I'll do a poll, something like that, to see what will work best for people. So, guys, thank you so much. Yeah, let's have a great week this week. It's going to be, every week's exciting. Every week we've got more stuff to look at. But yeah, thank you, friends. We'll see you. We'll see you on Monday for our breakdown. So take care.